The market is broken. Washington's own words. On February 4, 2026, Vice President J.D. Vance stood at the Critical Minerals Ministerial hosted by the U.S. State Department in front of representatives from 55 countries and said something that should have stopped every financial market in its tracks. He said the United States will establish reference prices for critical minerals at every stage of production, and for partner nations inside the preferential trade zone, those reference prices will operate as a price floor, enforced through adjustable tariffs. This is verified. Mining.com reported it, Fast Markets confirmed it. The U.S. Trade Representative's Office issued statements. The European Union, Japan, and Mexico have all formally agreed to work toward a binding multilateral framework. Let me translate what this actually means. The U.S. government is no longer relying on the free market to price critical minerals. It is stepping in, with trade policy, tariff enforcement, and a 55-country coalition, to set a minimum price below which these metals cannot fall within the trading bloc. That is not market economics. That is strategic industrial policy, and it is a direct response to what Washington publicly acknowledged at that summit. The current market for critical minerals is failing. Vice President Vance explicitly said the international market for critical minerals is failing, with consistent investment made nearly impossible by erratic and unpredictable prices. And then on February 17, 2026, Bloomberg reported that U.S. Undersecretary of State for Economic Affairs Jacob Hellberg confirmed that multiple U.S. agencies have developed a sophisticated price floor system and are actively having conversations with allied nations about rolling it out. Hellberg said the system will ultimately be deployed through Pax Silica, a U.S.-led alliance to strengthen critical mineral supply chains. This is not a proposal. This is a system that has already been built, is already in conversations, and already has partner nations signing bilateral agreements. Silver is officially critical, not a rumor, a federal designation. Here is the piece that directly connects all of this to silver specifically. On November 6, 2025, the United States formally designated silver as part of the 2025 list of critical minerals, as published in the Federal Register. The list now covers 60 minerals, up from 50 in 2022. Silver was added alongside copper, lead, silicon, and others. Silver's addition reflects its growing role in solar panels, EV electronics, and semiconductors, with photovoltaic demand alone accounting for nearly 30% of global silver consumption and rising. And there's a Section 232 angle here, too. A presidential executive order, signed in April 2025, explicitly found that imports of processed critical minerals threaten to impair U.S. national security. The EO directs the Secretary of Commerce to consider price support mechanisms, such as price floors, within negotiated trade agreements, framing price volatility as a national security concern rather than a market anomaly. Read that again. Price volatility in the silver market has been officially classified as a threat to national security. Project Vault and the $12 billion stockpile. On the same day as the Critical Minerals Summit, President Trump announced Project Vault, a nearly $12 billion strategic minerals stockpile backed by $10 billion from the U.S. Export-Import Bank and $2 billion in private funds designed to ensure that American businesses and workers are never harmed by any shortages. When a government starts stockpiling a commodity, it does two things simultaneously. It removes supply from the open market, and it signals to every buyer and investor in the world that this commodity matters at the highest levels of national strategy. Silver is inside that program. What this means, plainly, the U.S. government looked at the silver price, looked at the structural supply chain, looked at China's dominance over processing and refining, and concluded the market cannot be trusted to price silver correctly on its own. China controls refining. China controls an estimated 40 to 90% of the world's processing capacity for critical minerals, a concentration built over decades of deliberate industrial and trade policy. The Western response is now price floors, stockpiles, tariff enforcement, and a 55-country coalition. Both sides are making the same bet, that silver is worth more than the current paper price. They're just coming at it from opposite directions. China restricts supply. America guarantees price. Every single action on both sides of this geopolitical divide pushes silver in the same direction. Hecla Mining's numbers tell you what silver is actually worth the best year in 135 years of history. On February 18, 2026, Hecla Mining, the largest silver producer in North America, released its Q4 and full year 2025 earnings. The numbers are not subtle. Hecla reported record revenue of $1.4 billion for 2025, net income applicable to shareholders of $321 million, and record-adjusted EBITDA of $670 million. That net income figure, $321 million, compares to $35 million the year before. That is a 9 times increase in a single year. The company generated operating cash flow of $563 million, which translated to $310 million in free cash flow, with each mine generating positive free cash flow during the year. Cash on the balance sheet went from $27 million to $242 million. Total debt collapsed from hundreds of millions down to $276 million. CEO Rob Krcmarov called it exactly what it was: transformational. The number that actually matters, $69.28. Here is the data point buried inside Hecla's Q4 report that changes the entire conversation about what silver is really worth. Hecla reported an average realized silver price of $69.28 per ounce in Q4, more than double the $30.19 per ounce realized in the year-ago period. Now compare that to the COMEX benchmark price for the same quarter. The market average was approximately $54.83. Hecla realized $69.28. The market said $54.83. That is a $14.45 premium, nearly 30% above the exchange price, reported in an audited financial statement filed with the SEC. In Q4, Hecla realized nearly $70 per ounce for silver, with an all-in sustaining cost of $18.11 per ounce, yielding a $51 margin representing about 74% of the realized price. Think about what that gap between the realized price and the exchange price actually means. There are only 2 explanations. Either Hecla timed all their sales perfectly into late December price spikes, possible but unusual for a company of this scale, or industrial buyers are going directly to silver mines and paying a significant premium above the exchange price to secure guaranteed physical supply, bypassing the paper market entirely. The evidence strongly points to the second explanation. We already know that London lease rates hit extreme highs in late 2025 as institutions scrambled to borrow physical silver. We already know that Shanghai physical silver has traded at a substantial premium to paper contracts. And now we have North America's largest silver miner confirming from the supply side that the price people actually pay for real silver is materially higher than what COMEX publishes. The paper price is not the real price. The real price is what a willing buyer pays a willing seller for physical metal, and that price, according to Hecla's SEC-filed earnings report, is closer to $70 than to $55. Selling gold at $5,000 to go all in on silver here is Hecla's most revealing strategic move. The company is selling its Casa Berardi gold mine for up to $593 million, while gold is trading near $5,000 per ounce. They are choosing to exit gold at what many consider a historic high and doubling down on silver instead. After the Casa Berardi sale closes, silver will represent approximately 73% of Hecla's consolidated revenues, the highest silver revenue exposure among multi-asset mining peers. The company outlined a pathway to 20 million ounces of annual silver production in the medium term through internal growth at Keno Hill, optimization at Lucky Friday, and potential restarts at Nevada operations. And exploration spending is being nearly doubled, $45 to $55 million budgeted for 2026. These are not the decisions of a management team that thinks the silver move is over. These are the decisions of people who believe the most profitable years are still ahead. The people who physically pull silver out of the ground, who read every government policy, every industrial demand report, every supply chain signal, those people are betting their company's entire future on silver going higher from here. Greens Creek, getting paid to mine. One more data point worth sitting with. Greens Creek, Hecla's flagship mine in Alaska, delivered an all-in sustaining cost of under -$2 per ounce after byproduct credits in 2025. Negative. They are effectively getting paid to pull silver out of the ground, once the revenue from byproduct metals is accounted for, and they realized $69 per ounce selling it. That is not a mining operation. That is a money printing machine, and it runs on silver. The physical market broke, and the options clock is ticking. APMEX, America's biggest silver dealer, couldn't ship for a month. APMEX is the largest online precious metals retailer in the United States. They have been operating through every major market cycle for over 2 decades. They have massive warehouses, their own minting operations, and institutional-level procurement systems. In January 2026, they broke. APMEX added 4 extra business days to shipping timelines, fell 4 days behind on retail order intake, and instituted a $10,000 minimum order size specifically to reduce incoming volume and improve service levels. The company increased sales and customer service headcount by 25%, reallocating staff across the organization, as it anticipated longer hold times and higher contact volumes during fast-moving markets. On January 17th alone, a Saturday, APMEX recorded its third busiest Saturday in company history, with volume running 4 times a normal Saturday. And it wasn't just APMEX. The United States Mint temporarily suspended silver coin sales as it evaluated pricing adjustments, hours before silver hit record highs above $90 per ounce. Then on January 30th, silver crashed. In a single trading session, the price dropped from near $121 down to approximately $64, the largest single-day percentage decline in 46 years. And 18 days after that crash, APMEX published a letter saying shipping times had returned to normal. Now ask the right question. Did APMEX recover because supply caught up with demand? Or because the crash scared enough buyers out of the market that demand temporarily dropped, and APMEX was able to clear their backlog in the absence of buying pressure? Given that APMEX's own letter noted that many other dealers across the industry are still working through supply constraints and service challenges, the answer seems clear. The crash temporarily suppressed demand. Structural supply constraints did not change. The deficit is still running, the inventory is still draining, the demand is still growing. And when silver begins its next move upward, that entire cycle, record volumes, shipping delays, premiums, shortages, begins again, except this time with less silver in the vault than before. 35,000 in-the-money call options, 9 days to first notice day. This is the technical piece that the original script raised, and it deserves careful, honest treatment. As of the time of recording, there are approximately 35,000 call options on March 2026 COMEX silver futures that are currently in the money. These options give holders the right to buy silver futures contracts at prices below the current market price, meaning they are profitable right now. Traditionally, large commercial short sellers attempt to push prices lower before options expiration to knock calls out of the money, reducing the number of options that expire profitably and limiting potential delivery demand on the exchange. The January 30th crash, a 46% plus collapse from intraday highs, appeared to be exactly that kind of move, but silver recovered. From the $64 low, silver has climbed back above $78, a 22% recovery in roughly 3 weeks. And that recovery means tens of thousands of calls that might have been killed by the crash have come back into the money. Here is the arithmetic that matters. Each COMEX silver futures contract represents 5,000 ounces. If a significant portion of the 35,000 in-the-money calls are exercised and holders stand for delivery, the potential delivery demand runs into the tens of millions of ounces, against COMEX registered silver inventory sitting around 98 million ounces, against an open interest that represents far more. Most options traders close for cash, they do not take delivery. But here is what is genuinely different about this moment. Industrial buyers need physical silver. Hecla's earnings confirm that buyers are already paying 30% above the exchange price to secure direct supply from mines. In that environment, the incentive to exercise calls and stand for delivery, capturing the arbitrage between the exchange price and the real-world physical price, is higher than it has been at essentially any point in the modern history of this market. Whether that pressure manifests on February 27th or afterward remains to be seen, but the structural conditions that would make a delivery squeeze possible are more present right now than they have been in decades. Connecting all 4 signals. Step back and look at all 4 of these stories together. A U.S. government price floor, confirmed by the Undersecretary of State, agreed to by the EU, Japan, and Mexico, that explicitly acknowledges the silver market is pricing incorrectly. A verified earnings report from the largest North American silver miner showing a 30% premium above exchange price on actual realized sales. A public admission from the largest U.S. precious metals dealer that physical demand overwhelmed their entire operational infrastructure for a full month. And tens of thousands of in-the-money call options approaching expiration on an exchange whose registered inventory sits at a fraction of potential delivery demand. These are not rumors. Every single data point in this video is sourced from SEC filings, government statements, official earnings transcripts, company press releases, and verified news reporting. Each signal, individually, is interesting. Together, they describe a market in structural transition, where the paper price is increasingly disconnected from the physical reality, where governments on both sides of a geopolitical divide are moving to control silver supply and price, and where the largest actors across mining, retail, and industrial buying are all behaving as if the current price dramatically understates the real value of physical silver. The floor is being built. Physical buyers are already paying above it. The exchange is under pressure to deliver metal it may not have at scale. That is where silver stands right now. This is Mindverse. Do your own research. This is not financial advice, but the data is real, and the picture it paints is one you should understand before the next move happens. China controls refining. China controls an estimated 40 to 90% of the world's processing capacity for critical minerals, a concentration built over decades of deliberate industrial and trade policy. The Western response is now price floors, stockpiles, tariff enforcement, and a 55-country coalition. Both sides are making the same bet, that silver is worth more than the current paper price. They're just coming at it from opposite directions. China restricts supply. America guarantees price. Every single action on both sides of this geopolitical divide pushes silver in the same direction.